Hey, it's Rick. Thursday, December the 1st. Can't believe it's December. This year is almost done. To the market, the risk model hasn't changed. We're still, the moving averages are all moving very nicely in the right direction, stacked in the right order. But we closed basically exactly where we left yesterday. So we're right at the 200-day moving average for the S&P. But the SPYs or the QQQ are still lagging, as we'll see. Those of you that watched yesterday's video will recall that I sold just before the close Dollar General because they were reporting earnings this morning. I took a small loss on this. I think I entered up here around 257 and change and sold it at 254 and change. So about a little over $300 loss. My rules just say you can't hold over earnings. And sure enough, this thing opened down about 10% today. Now it could have easily opened up 10%. And I wouldn't be kicking myself. I mean, that shit happens like that. I'm always trying to be protective of the downside. And sure enough, this I took a $300 and some odd loss instead of a $3,000 some odd loss. So, and this chart is busted now for some period of time. But there is a little bit of a lesson that could be learned in here for some of you who are holding things. You're not aware of when the earnings are being announced, or they just do this. They gap down on some other kind of news. And then how do you handle it? Well, the first thing is not to panic. That's not the end of the world. Hopefully it's not your entire account in the one stock. So position sizing really helps. But the first thing I do is I look at an intraday chart. This happens to be a 65-minute chart. 60-minute chart would do fine. A 30-minute chart will do fine. And what I do is I just sit and do nothing for the first 60 minutes. And I wait for this first bar to close. And wherever the low is for that, I then mark that with a line and I place my stop at that number. If it goes down in the next 5 minutes lower than that, well, that's the way it goes. You never know that it couldn't go back to the daily. I've seen stocks who just do this all day long and drop like 25%. So at some point you have to draw a line in the sand, and for me it's the 60-minute low. Often the selling will abate by then and the stock will begin to recover, and sure enough, I guess that's what happened with this one. I've no longer watched it. Once I watched it, I knew it was going to gap down right before the pre-market, so I didn't even follow it all day. But so if you're ever caught in this situation, again, this 60-minute rule works quite often. At least it gives you a line in the sand that says I must place my stop here and take my loss and be done with it and move on. Now, what I don't have a rule for is if it does this, as it has done so far, it's when to sell it. Your first loss is your best loss. So I don't have any rules for that. I would guess that maybe on a 30-minute time frame or a 60-minute time frame, the first time it closes below the previous bar, I would sell it. So you save yourself a little bit from the ultimate low, because the expectation is this low here that it set in the first hour is going to be broken in the next 2 or 3 days. It is highly improbable that this thing would just rip back up into this area in here and you get whole again. So hoping to get whole is just not the right way to do it. You put your stop in, take your loss, and move on. So hopefully you learn something from that. Hopefully you won't get caught in that to begin with. So turning to the market, S&P. I say we closed. There's where we closed yesterday. Here's where we closed today. Virtually identical. There was a bit of a range. It gapped up a little bit, traded down, recovered. So it's sort of a quiet day. volume dropped off quite a bit. But it is good to see it's closing right at the 200-day. I would really like to see this stay quiet for a day or two. Looking at the cues, we're still a similar kind of day. After that beautiful move yesterday, we basically closed exactly where we did yesterday. So, but it's still a ways to go to get to the 200 days. So there's about almost 5, yeah, right around 5.5% below the 200 days. So that, conceivably this could move up into here, which if that happens, we'll go back to the S&P. The S&P will probably, move up into this area up in here somewhere. And then just quickly go to Toronto, because I do have a trading idea investing idea for you, some of you people that are index investors. So Toronto has been holding up much stronger. It's been living above its 200-day moving average for 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, about 3 weeks now. So this is showing much more strength. So the question is, are we, I go to a weekly chart, are we in a bear market rally? And this is going to roll over, although Toronto does look stronger compared to S&P. S&P is just coming up to this downward sloping trend line. So this has been a nice rally from here to here. How much more is it going to go? So that's a bear market rally, and then we just head back down. Or is this the start of a bull market, and we're just going to now head, continue chopping higher and higher and higher? So don't know. But either way, this looks like it wants to go higher for at least the next 3 or 4 weeks. So how do we take advantage of that? I'm going to start with Toronto. And a trade that I will take tomorrow in my wife's account, because it's in Canadian funds, is if the XIU opens inside today's range. In other words, it doesn't gap up, because if it gaps up, I don't want to be buying it up there, because after this kind of a move, a gap up oftentimes will fall back down. If it gaps down, then your timing has got to be impeccable as to when you get back in again. So I'm hoping that it will open inside this range, in which case I would buy it. So where would I put my stops? So I'm going to, one logical stop would be underneath here. And a second logical stop would be underneath here. So if it takes out, this is a big wide range bar from yesterday. If it takes that out, this whole next up move is suspect, but it's not totally damaged. So I would just sell half. But if it takes out this low down here, this is busted, and we could be on our way back down here somewhere. So I'd want to be out. So measuring risk, if we enter somewhere, let's say we enter near the top of this range, right around here at 31.45, let's say. So we're down to here is 2%. That's quite tolerable. And all the way down here is 3.7%. So that's a reasonable, that fits my definition of a reasonable risk reward trade. So I'll pull out my handy dandy tool, and I'm going to assume that you're 100% cash, that you haven't, you're just now getting to the point where you're going to get invested. You have $100,000 account. I would not go all in at this point. The max I would recommend would be 50%. So you would have a 50% $50,000 position. And the reason I say that is because we're not in a confirmed uptrend yet. While the moving averages here are nicely stacked, this is the 8-day moving average, this is the 21-day moving average, this is the 50. They're stacked in the right order, they're going in the right direction. But this 200, we haven't lived, it hasn't really started to turn up yet. So out of abundance of caution, I would only recommend 50% exposure to the market at this point in time. So here's how we use this tool. So my first stop, what do we say was here, was $30.80. And the second stop is down here, 30.31. Let's say it's $30.30. So an average of 30.55. And let's say we enter basically where it opened today, 31.45. Let's just pick that as an entry price. So this whole trade, our risk is 2.9%. Risk in dollars is 90 cents. To put $50,000 into this trade, it would be, we could buy 1,590 shares. And our total risk is $1,431. So if this shit hits the fan and this gets stopped out, the damage to your portfolio, you lose $1,400 on a $100,000 portfolio, that you're risking 1.4%. That's so easy to recover from that. So this makes some sense. So that's one way I would trade this. Now, a second way I would trade this is there's an instrument called on Toronto XH or HXU, which is leveraged. The pattern is exactly the same as the XIU, but this runs up or down twice as fast as the XIU. So for example, today, XIU on the right-hand side of the screen here was up 0.29% for the day. This HXU was up 0.51%. So not exactly 2 to 1, but close enough for rock and roll. So I would approach this trade the same way. I'll bring that back up my tool. Let's see, my entry would be, we'll say 1990. So entry price is 1990. Now my stops again are going to be 2 of them. There's going to be one under here, say 1915. And the other stop is down here at 1840. So now here, because we have 2 times the exposure, I would only put $25,000 into this instrument. And we end up with basically the same amount of dollar risk, $1,400 we're risking. So same thing would happen if this one fails. The result's going to be almost identical to the XIU. So you might say, well, why the hell would I take this one over the other one? Well, we know how to manage risk. And this is making the assumption that you know how to place your stops, you will honor your stops, you won't pull them, and then you're very disciplined that way. So you cap your downside. The advantage of the HXU is that it goes up twice as fast as the XIU, and so you're able to get this does go up, you're able to get your break-even point faster, and you're only committing 25% of your entire account balance. You still have 75,000 of your 100,000 starting position in cash, so that if this continues to work, you've got more capital to employ in something else or the same instrument again if you want to double up on it. So your downside risk is the same, but you're only risking 25% of your total capital and leaving more capital available to work for you. So that's why I favored this particular approach. So that's I'm gonna this is what I'm gonna do tomorrow. Again, the proviso is that the stock does not gap beyond there or gap below there. It opens inside this box, and if it doesn't do that, then I won't take this trade. On the US side of things, you could do exactly the same thing with the S&P 500. Except in this instance, where I had, going back to HXU, we had two stops. We had one stop here. Darn tools. We had one stop here. And another stop down here. In the case of SPY, there's just one stop. Okay, and that stop would be, out of an abundance of caution, would be down here. So that is, say we get in somewhere up here, we're risking just over 4.5%. So the same principle applies. I would except here I'm going to use the double, which is SSO. And I'll bring up my tool. Oops. Wrong one. And the stop is, what do we say? It was down here at 46.45. And there's only one, so we have to put this in twice. And my entry, let's say we enter it right around where 50.90, that's close enough. We have an 8% risk. But again, we're only taking half a position. So we're taking this column here. So we're risking $2,200. So the risk is, in dollar terms, is now $2,000 on $100,000 accounts. So we're risking about 2%. But with the same premise, this is a double, a leveraged ETF, so that the upside is much faster, and we're controlling the downside. And so, yeah, half position on that at $25,000 would be 491 shares. So that's two approaches, and again, I can't reiterate enough. If you do this, you have to be at the open, and this trade is off if it opens outside this box, outside of today's range. So it has to open somewhere in the middle. And tomorrow is a jobs report, and I think it comes out about an hour before the market opens. So we're going to know as soon as the market opens whether this trade's going to be invalidated. Okay, sounds maybe a little more complicated to some newbies. And if you need me to answer any more questions on that, by all means, please reach out. But to me, this is a decent risk-reward trade. If we believe that the market is going to continue this short-term trend, we're going up. So we put in, here was a low, failed to put in this was a lower high, put in a lower low, and then came up here. It's another lower high, but failed to put in a lower low. This becomes a higher low, and then a high, a higher low again, and again, and again. So we're in sort of a short-term uptrend, and looking for this to continue into sort of this zone out here over the next 2 to 3 weeks by Christmas. Okay, that's all I've got for you for tonight. Maybe have another video for the weekend. Cheers.